Hello, everybody, and welcome yet again to another episode of Dude, this is crazy. No, this is an episode over here. We're at exercise 17.5, and we're going to look at effective interest versus straight line bond amortization. This is if we're holding investments. So on January 1st, 2020, Phantom acquired $200,000 of Spider-Man Products, Inc.'s 9% bonds at a price of $185,589. Interest is received on January 1st of each year. Bonds mature on January 1st, 2023. So it's a 4-year bond. So 2020. Okay. So the first thing I want to just kind of show you, though, is that how do they get that 185,589? And when you look at this, you need to know two components. One is going to be what's the face value of the bonds. The face value is 200,000. Okay. And the face value and these pay, the interest rate or the interest paid is going to be 200,000 times 9% or 18,000. The 9% refers to the stated rate of basically of these bonds. So the next thing we're going to go through and do is then we're going to go to the present value tables. So this is going to be present value of $1. Now, if they're priced to yield at 12%, this is going to be 4 periods or the number of times interest is being paid. So over here, interest was received on January 1st. So it's actually, I got this screwed up. It's a 3-year bond. It's going to be 3 periods at basically 3 periods at 12%. And the reason why I screwed this up, this is 1/1/20. They're getting the interest on January 1st. So there's going to be no interest because time has not elapsed. So this is really year 1, 2, and 3. So there's 3 periods. For the interest, I'm going to do present value of an ordinary annuity of $1. And this is going to be 3 periods at 12%. So when I come over here, so I'm going to go 3 periods at 12%. So this is for the lump sum. The present value of $1 just does lump sums. So this is going to be 0.71178. And then over here, I'm going to go to the present value of an annuity of $1, 12% at 3 periods, or 2.40183. And when I add up these two amounts, so how they price this bond. So when you see this 185,589, this is how they got it. And I want you to know that this is, I think it's important to understand whenever you're seeing the numbers. So that's my opinion. Okay, so let's go through and have some fun. So we have the carrying value is going to be 185,589. So then over here, my interest revenue is going to be the carrying value times 12%, which is the market rate of interest. I can do it like this. Hold on. So my market rate of interest, I'm going to move these down 1 because I'm not getting, we're doing this at the end of the year. So my interest revenue is going to be 185,589 times 12%. And this is going to be the effective interest. I'll go and do straight line in a second. So this is going to be giving us our interest revenue. The cash received is going to be the $18,000. So I'm going to need to write up my investment because by the end of the third year, it needs to be at 200,000. So the discount amortization is going to be the difference between these two. And my ending carrying value is going to be this over here. And let's make some. So my ending carrying value is going to be right over here, 189,860. This here becomes my beginning for the following period. And whoa, we got a crazy thing coming here. So this should be 18,000. There we go. And let's try this one more time to see if we can get it. There we go, to 200,000. So the 3-year schedule of interest revenue and bond discount amortization using the effective interest method, that's what this is right here. If we were to do straight line, okay, what would happen here? What would be different? Well, the only thing that's going to be different is that when it comes to the amount of the discount, which is going to be the face value of the bonds, or 200,000, less the less initial. My initial carrying value is 185,589, so my discount is going to be 14,411. So my annual amortization of this discount is going to be 14,411 divided by 3, because if it's straight line, that's what that's referring to. So here, my carrying value is 185,589. My calculation of interest is going to be a little bit different. So here, my cash received, or say my discount amortization, is going to be 4804 each one of the years. And so then my cash received is going to be 18,000. This will be the same every year. So my interest revenue is going to be every year 22,084. So the ending carrying value is going to be 185,589 plus the discount. And so then if I follow along and I take this here and go through, and I'll do the little letters above in a second. And then if I take this, so I'm slightly off because probably it was a rounding issue. Okay. So how do we go through and get this? This is going to be, we'll call this A1, G1. My discount amortization, this is how I got that value. This is 14,411 divided by 3. So we'll just call this B1. We'll call the cash received C1. So my my interest revenue is going to be B1 plus C1 is D1. My ending carrying value is going to be my beginning plus the amortization of the discount. And so that's how we're getting that there. Wow. Okay. So prepare the journal entry for the interest revenue and discount amortization under the straight line method for at December 31st, 2021. And then it's also under the effective interest. Okay, so let's go through and do that. So if I'm recording interest revenue, so we'll do this debit, credit. So the actual form of the journal entry itself is not going to change. I'm receiving cash. The cash that I receive under both methods is always going to be 18,000. So what is going to be changing is I'm going to be writing up my investment. So my investment in bonds, this is going to be under the effective interest for 2021. This would be 4271. And my interest revenue is here. This is going to be the same each year. And let's just take a look to see what these journal entries look like. Yep, this is straight line. And then this is, oh, I screwed this up. This should be, oh, this is the beginning. Actually, I screwed this up. This should be 4783. And then this will be 22,783. So I made the mistake. I think I chose this one. So it's really this one here. The straight line amortization isn't going to be making a difference. So that's always going to be the same. So that's how we go through and do that particular question. And let's try to highlight this one too. Okay, so entries for equity securities. The following information is available for Barclay Company at December 31st, 2020 regarding its investments. Prepare the adjusting entry, if any, for 2020, assuming that no fair value adjustment account as of January 1st. Neither of Barclay's investments result in significant influence. That's important to know because of the equity method of accounting. So as we go through and look over here, so what we're going to do is we're going to group these together because they're kind of common types of investments. So the fair value is $5,000 higher. So what we would do is we would say here, investments. So I'm going to be going through and debiting this here for 5,000. Why am I doing it for 5,000? It's the difference between the 70,000 less the 65,000. And this here is exercise 17-6. Okay. So, and I'm going to be crediting unrealized. Holding gains or losses for $5,000. And I would be making this entry over here on 12/31/20. If I did have significant influence, I may have to go through and use what we call the equity method of accounting. And how are these items reported in the financial statements? So the investments are going to be reported at fair value or $70,000. So here the investments are going to be recorded at $70,000. And the unrealized holding gain or loss is going to be shown as a portion of comprehensive income. And this shows below the regular operating activities for the company. So like right over here, it's other comprehensive income. And where does that then go? It's going to be showing up over here under our shareholders' equity. And this is used for unrealized holding gains or losses on securities. It's also used for foreign currency translation adjustments. So that's exercise 17-6. So thank you for joining me today, and I look forward to seeing you on the next video. Have a great one.